In Congress, the swamp gets muddier. It's earnings season, and there's some big moves in stocks in both directions. And the what me worry market, well, it starts to teeter. All that and much more when we start the show.
Well, I'm going to the city and I'm gonna do a city show. And I know all my fans wanna learn how to make some dough. I've been cruising up and down for trades each and every night. And with my iPhone reclining, I know we're gonna get it just right. I'll get inside your mind, we'll have a real good time. We're gonna trade today, we gotta trade today. Go askSlim.
Hi, I'm Steve Miller. Call me Slim. And this is the askSlim Market Week. It's a look back at what happened in the financial markets in the past week, and a look forward to what might happen in the next week, and hopefully lots of good ideas and opportunities for you throughout the show. Well, the stock market had a choppy week. Actually, Thursday brought a pretty good air pocket as we saw the big tech stocks have a big reversal, and the NASDAQ fell some 120 points or more intraday from being up early to falling down there 100 points. So it was a big sell-off that came, and we had talked about air pockets potentially coming for the stock market as we got into a riskier period here, and that may be just the beginning of it. Earnings, well, it's deep in earnings season, and we're getting some pretty big moves in both directions on stocks, and that's been pulling the indexes around, especially pre-opening, and we've had some days where the index seemed to just relentlessly open higher and higher, but now we're getting a little bit of different tone in the markets. The Senate, well, they just can't seem to get anything done when it comes to health care here. It doesn't matter if it's a fat bill, a skinny bill. I mean, no matter what, they're ugly bills, and they can't seem to get anything passed, and everybody's starting to question agenda again, so they just probably going to let the whole thing go and move to tax reform, and we'll see if they can get anything there done either. FOMC came out this week, and they did their usual thing, super dovish, not really being very clear. They're getting closer to starting to think about rolling back that their big balance sheet there, so they're just kind of putting that on the table. It's all about testing the waters in the markets and seeing how the markets respond, and you know, we get 2.6% growth for the second quarter. It's better, but it certainly isn't very strong, and 8 years plus of 0% interest rates, well, we have 1% now, and the markets have been the only thing moving up in the economy, and mainstream is just plain left behind. So they're scared to death to do anything too dramatically, and you can see that by their attitude. The shareholders, well, they might actually be getting worried as we see the stock market starting to teeter a little bit, and that's after we had a VIX reading that is historic. 8.84 intraday low in the VIX, and that is the ultimate of the what me worry market, that it was just unbelievably complacent. So we have the consumer sensitive area starting to show some weakness, especially the airlines really getting their wings clipped as we've had some pretty good declines. I'll show you a bunch of those stocks later in the show. And then we have the stock market just trying to get a little bit of stability here on Friday, but not really able to, as we've seen some of the big stocks that people have loved start to really come apart. Starbucks get hit pretty good. Domino's Pizza, some more of these tech stocks as they start to get hit. And you know, when you see some of these stocks that seem like they were just impervious to anything on the downside start to get hit this way, then you really start to have to think that the investors and analysts are going to start to want to lighten up at these extreme levels in the stock market. For the week, the S&P 500, the Russell, the NASDAQ, all just fractionally lower in this very choppy week. The Dow Jones Industrial Average, the best of the indexes, up a little less than 1% on the week. The Dow Jones Transportation Average, as I said, airlines really took it, and also the shippers are starting to come down, and the rails have been weaker. So the Dow Jones Transportation Average down 3% on the week. And if you remember, I showed the megaphone tops last week, and the Dow Jones Transportation was one of them. And I said it's likely to pull back from the top level there, and it certainly has started to do that. The bond market, 30-year bond, down about 1.5 points for the week. It was 2.5 points to the downside, so that's really weak. That was in line with our expectations that the bond market would be pulling down again. Interesting note in something I read that Europe, they've got these big balance sheets. Also, is the ECB buying like crazy, and they also have a lot of corporate bond holdings. Euro corporate bonds are at a record low number here, and that's in the high yield category, averaging some 2.5%. I mean, there is some craziness there. So the bond market certainly has risk, even with the Fed being on the dovish side, but we're only seeing so far modest pullbacks. So the dollar down again, the bottom in there is very elusive. We're looking at a potential short-term bottom and getting a bounce in there for a month or more, but it has not started at all, and you have to give credit also to the dovish Fed for that, in that they are likely not to be moving too dramatically, so the bond market's decline, well, we'll call it modest at this point, but I think it's likely to pick up again, the bond market. And if that's the case, we're going to see, once we get some more weakening in bonds, we're going to see some bounce here in the dollar, and that's actually what we were looking for. Gold, 3 weeks in a row here, moving to the plus side, some $20 right now, and that's also accountable to the dollar's weakness in here, and the Fed, the Fed dovish essentially, so that boosts the gold market and the silver market. And then of course there's the hope of the Fed agenda, of the Trump agenda, stimulating things. So silver gets up 19-20 cents on the week also, and they're in a pretty tough resistance area here, and you'll see for our members in our short-term view that we think this is an important spot for gold and silver. Oil soars 9% on the week, some $4 plus in the oil market. The hopes are that these oil producers are getting control of prices. Problem is that once you get up around this $50 area, which it's now edging up to for light sweet crude, then it brings out those shale producers, and you get a bigger amount of supply coming out, and then oil stalls. We think oil will stall here, and then get some pullback. And again, we'll talk about that for our members in our short-term view for the week. So I saw an article that I think is really worth sharing, that I think about the stock market. Sometimes I don't go for, I'm a cycle guy, so I look at specific historical movements, but then when people come out with things that they say happens, there's a 7-year crash, and there's things that happen historically that I start to wonder about. But this one here, when you look at something that's actually happened 10 decades in a row, then you got to say, well, this is worth looking at. So I want to share it with you. So I saw this article that MarketWatch put out and Sue Chang was the one that put that out. And it was on research from Dana Lyons, from Lyons Fund Management. And I'm going to show you an interesting slide in here. And we'll take this by each decade. And I'll let you let me know what you think about this. So what do we have right in here? This is about the second half of each of the 7th years of the decade. So what are we looking at here? We're looking at 1907 all the way to 2007. That's 11 of those, or it's 10 of those decades. And we're looking at the 7th year of the decade. And of course, this is now 2017 and the 7th year of the decade. 1907, there was a cyclical bear market in the second half. Now remember, we're looking at the second half of that particular year. There was a 24% decline. Worst level was 35%. 2017, a cyclical bear market, 22% decline. The worst level was 31%. 1927, that was a huge bull market. There was still a 9% drawdown in the second half, but it actually gained 21%, but you have a 9% pullback there. 1937, of course, this was after the Depression and FDR trying to do, well, Keynesian stuff, and the market then after that depression and rebound fell 29%. Worst level down 41% for the second half. 1947, not a lot went on. Overall, there was a 2% gain, but it did fall 7% at one point in the second half of the year. 1957, it went straight down from July. And there was a 13% loss for the second half, and it was a maximum of about 20% down. 1967, it was up 5% for the half. It was down the whole fourth quarter, and there was a 12% drawdown there. Cyclical bear market in 1977, at worst case, down 15%. It was down 9% for the second half. 1987, we all know there was a crash. At worst level was down 41%, 20% decline for the second half. 1997 was the Asian crisis, and there was a quick 17% decline in there. And 2007, which was the beginning of the major decline, bear market, had a 10% drawdown there in the second half of the year. And I want to, again, thanks we'll give credit to Dana Lyons from Lyons Fund Management Incorporated right over there for this really great information. So what does this say? This essentially says that the in the last 10 decades, that's 100 years, the seventh year, which we're in right now, in the second half of the year, had a major drawdown in every single one of those years. Well, some of them were only 9%, 7%, but other ones were as much as 41%. Where are we right now? Well, we have not had a 5% drawdown in the fourth longest time in history. So, and talk about something being due, well, that's where we are right now in the second half of the year, and the likelihood that there will be some significant drawdown. You know, I've been talking about some 9-10% correction, and I also have been talking about the likelihood that that was coming in August, early September. Well, with this market getting a little shaky and an 8.84% VIX last week, this says to me that complacency reached just a level that's incredible, and that maybe we do get 2017 as another year with a significant drawdown in the second half of the year. I thought that was really interesting stuff. Let's take a look at our 60-minute chart of the S&P 500 and see what happened during this week. The gray area being the overnight trading in the S&P 500, and the white area being the trading during the trading session, the regular pit session, as dinosaurs like I would call it. So here on Monday, you saw not a lot went on. It was kind of choppy. Eurozone was lower as their business survey showed slowing. So oil gained on report that Saudi was cutting their exports by a million barrels a day. That was a huge cut, and that really started oil moving on the upside. Google had on Tuesday, they came out, and that was actually Monday night, that they said that they were soft on their ad clicks, and that weighed on the NASDAQ. The market tried to get a move on the upside in here, but you could see overall it was choppy, and late in the day did sell off. Bonds were down big on tightening fears, but the Fed didn't really prove that on Wednesday. On Thursday, you can see the markets tried to rally again overnight. These are usually just on earnings, pushing things up overnight. The Fed came out as expected with no change. You got the no change. Overall, super dovish. They say balance sheet to start to be reduced relatively soon. This is all that ridiculous verbiage that you get out of them that's meaningless. Somebody said to me, posted something about the Fed and who the new appointment would be for the Fed chair, and my response is, how about nobody? How about just getting rid of the Fed chair and rid of the Fed, and let's get real market discovery? Yeah, there I go ranting again about it. Boeing comes out with great earnings, and it soars, and that lifts the Dow. But overall, you could see where that FOMC news came out, the market just didn't do all that well. The Dow did much better. So U.S. stocks up early and mixed, even with the NASDAQ being strong. Now, the big move of the week was on Thursday. Facebook came out with a beat, right? And they lifted stocks early on, so you can see that they were strong overnight. But then the techs really started to get slammed. And you can see here in the S&P 500 that it moved down from 2479 to 2457. So there was a very fast 22-point drop in the ES. And that is the biggest that we've seen in a long period of time. And this could be the start of something. That really is what it feels like, as we got early and then this big crack, and then everybody covers their shorts on that big rebound right over there. On Friday, you got some firmer, some lower markets in the world markets. The U.S. market tried to hold early on, but it really couldn't, and overnight some selling came in. And you can see here, as we get with about 2 hours left to go in the day, that the market is just kind of chopping around in here. Amazon disappointed. Starbucks got cratered on their earnings on Amazon. We'll talk about that in a couple of minutes, as Amazon finds out that in order to destroy the rest of the retail world, they have to spend some real money. Let's take a look here as we look at our calendar for the coming week, and you can see that right in here. As far as earnings go, we're still right deep in the earnings season, and you can see that we have some important earnings coming out. There's Apple after the close on Tuesday. There is Tesla after the close on Wednesday. Though Tesla is in my opinion in a very bad pattern. And now as we get into where they're actually starting to deliver their new Model 3s, it's going to take a long time. I mean, some months before they really get their production up. I think they're actually going to only deliver a few cars in the next couple of months, relatively few, and then towards the end of the year they are supposed to get their production up to some 20,000 a month. So we'll see, and we'll see how many people cancel out of 500,000 pre-orders for those. So we know there's going to be some cancellations on those. Average car is going to be 45, 50 grand, not the bogus 35 number they're talking about. So there I go off on Tesla, which I really think is in a bad cyclical pattern in there. You could see that the news coming out for the week, the big news is the ADP employment. That's the private employment on Wednesday. And then the regular employment numbers come out there on Friday. ADP has tended not to be a market mover, but the regular employment numbers could actually be a market mover. So that is the calendar for the coming week. All right, so what we're going to do now is we're going to get into the best and worst stocks for the week, which we always do. Some very interesting stuff, and probably some long segments coming up here, because there is certainly a lot to talk about. And here you go as we move into the best stocks for the week. All right, best of the week. We're going to take a look at these stocks, which had some pretty significant moves. Let me get my notes out here for you to see as we look at the biggest mover being in the retail segment. You know, the retail segment has been absolutely killed. And then what happens is that, well, you start to get some short covering coming in and some markets that start to move up, or stocks that start to move up because they well, just got sold in a crazy way, and the first sign that, well, Amazon starts to falter a little bit, you start to get some bids coming in. The biggest stock, biggest move of all of the stocks that I look at, more than 300 of the widely held, was Dillard's department store. Go figure. It gets up into an important area, up 13% out of the week. No news really in there, and I say sell. This is a really important area right over here, and it's made this move, I mean, from 45 up to 77. It made a nice base. I mean, we call this a base right in here, where you can see this pattern right in here. But that to me is a set up this big spike in here. But $77 on this stock after what all retail's gone through, I actually think it's a gift to people that are alongside holders in here, and I think it's a plain out sell in here. Best Buy gets up about 6%, and I think that one is going to, which overall is better, is going to move into a little bit more correction also. Earnings in Best Buy come out on 8/29. Next stock we're going to look at is Freeport, FCX. Freeport is a stock that's really a copper and gold stock. It's in a group that we had turned more positive in, saw some bottoms forming in there, at least on a temporary basis, and it moves to the upside. So it gains also 13% on the week, a number of 13% gainers in there. You can see here as we have all kinds of cyclical patterns lined up on the bottom. And there were important bottoms that you could see right in here where those blue lines are, those blue spikes. We have, this is the copper, and copper exploded to the upside. Gold has been also on the strong side, and this is the DBB, that blue line, which is the base metal. So base metals, gold firmer, copper exploding, and that gets you this rally right in here. Now it gets up into this resistance zone, and I would say that, you know, it's getting up into a tough spot for it. The news was that it swung to a profit after having lost money, and that has definitely attracted the buyers, but now it gets up into this intermediate resistance area, and I think it is likely to struggle in there. We're looking for a pullback in copper because it got crazy on the upside, so FCX probably pulls back, but I don't mind this pattern in here. I think it's so overall maybe setting up longer term for a more favorable pattern. I just wouldn't chase it here on the upside. Here is Boeing. Look at this move to the upside in here. I mean, this is just incredible. It moves in a 13%, very significant way. Earnings just fantastic. Their guidance super strong. Analysts all over this one upgrading it. It gets up to the 100% fib extension and beyond. You can look over here at the 161.8 fib extension. Down the road, that's 270. I wouldn't be surprised if it trades 270. How do you like that? So right now we're looking for a corrective period in here because we think the stock market's going to correct into August, late August, early September. So we'll look for it to pull back in here. But man, we think that would be a pretty good buying opportunity if you can get it right somewhere around that 227. How about 216? I mean, it's possible if the market gets sold pretty hard on the downside, and then up to that 270 number, that would not surprise me whatsoever. So that's a look at Boeing. Baidu gets a pretty big gain, also up some 12% on the week. Earnings really strong. Their mobile ads just smoking it, and the stock explodes to the upside. And bullish pattern. You can see our cyclical pattern in here, and look at the rhythm. So this is the ideal cycles right in here, right? And when you see the declining phase, well, it declines. When you see see the rally phase? Well, it rallies. You can see that as it follows those cyclical patterns pretty spectacularly. This one a little bit long, gets into the rising phase and explodes to a new high. 225 it trades up to. We think that if it gives any kind of a pullback in here, you can buy it. It's probably going a lot higher. Baidu looks absolutely great. So we talked about oil moving up in a very, very strong way and getting up towards the $50 a barrel number. The energies were really strong, and we've recently done some videos where we talked about the likelihood that energy stocks, oil stocks, would be the participants in any rotation that came. They would start to get some bids in them. And that is actually what we saw happening, and especially as oil's firmed. Now, Exxon actually down about 1% on the week compared to the rest of the group. That, to me, is just one of the screaming buys. And we gave that information out to our members this morning, so on Friday morning, and hopefully a lot of them started to enter. We're going to take a look at a bunch of these stocks just so that you can get a sense for what we're looking at cyclically. So I'm a cycle analyst, and I look for the repeating rhythms of the market. It's actually the heartbeat of the market, which is a visual depiction of the flow of money in and out. And once you get a real feel for that, you get a much better feel for the market. So we're going to take a look here as we look at just a few of these energy stocks that had nice gains. The first one we're going to start with is APC. APC is Anadarko Petroleum, and I want you to see the cycle rhythms in here that called for a bottom to be coming. Now, this stock has fallen from around 73 down to about 43. So that was a giant move, 30 points to the downside, huge percentage. Here's your 100% fib extension level right over there. It essentially measures this level and this level right in here and points to that level, and it got really close to it. Now, to explain the cycle analysis in here to you, what we have in here is a repeating rhythm of cycles. When the cycle is positive, like you could see right in here, that's this one, right? You could see how we've drawn that. The odds are high that the next cycle is going to do really well. When the cycle like this gets you nothing and then breaks down, the odds are it's going to decline through the distance of the next cycle. You could see it did that perfectly. We're now entering this rising period as oil is just starting to move up. This is going to attract value investors that are looking for something when they're selling out these ridiculously high priced things like Amazon that are just crazy valuations. Tesla, crazy valuation. Netflix, crazy valuation. But Anadarko, well, there's something that looks like it's got some value to it, and the cycle phase turning up. So we expect that Anadarko, up 7% on the week, is going to continue that. Take a look at COP, ConocoPhillips, and you can see in this one, it looks like it's starting to turn up, but I say to this one, which is up 7% in the week, not quite yet. The same thing in WLL, Whiting. I think not quite yet for that one either. But Marathon, you could see it's now entered into this green zone. So this is our colored phasing, green in the rising phases, yellow in the declining phases. And then when we get into the green phase early in here that you can see, which is the rising phase, and we have, well, oil doing what it's doing, we expect Marathon to do real well. Marathon is trading at 11. In the 11s, it bounced up into the 12s. I think it could go to 14 pretty quickly. So that one is looking, in my opinion, really super good, and I think a great value. CVX is one that also looks similar. You could see it was in this negative red period for that whole entire cycle period right in there. So this rally went nowhere, and it broke down and then gave you the decline through that whole period. Isn't that gorgeous? You could see in here the positive cycles right in here. This one kind of neutral. Then then when it broke out above this downward trend right there, it explodes to the upside. Now you can see right in here that this looks like it is getting ready to break out of that downward trend and then explode to the upside. Let's take a look at it in the daily pattern right in here, and you'll just get a sense for what I look at in the multiple time frames. And I'm going to move this out to a 2-year daily and look at this decline right in there. So you can see, look at those gorgeous cyclical patterns as each one of them stair steps down, and you could see as it turns negative right here, downward stair step, downward stair step. Look how it follows these cycles almost perfectly. A base being built right in here and then explodes up through the resistance area. Here is your downtrend you can see coming right across here, which it breaks out. It moves out above the 89-day moving average for the first time. And do I need to tell you that this looks super positive to me? Maybe you get a pullback in here as it moves through these resistances, but then I think it moves up again. So that gives you a good idea as CVX how that looks like it's really in good shape, and get an opportunity to buy it, I think, soon. Here is Exxon. They came out with earnings, and the earnings were not good, and the stock got hit. And the stock got hit while these other energies have been doing better, except that we're in the final stage, and I think that we got some capitulation today. So look right here. This is a declining phase. You see that? Look right here, the declining phase. You see that? Here it was strong. It could barely decline, and then you got this rally that was really strong. And here you could see the end of this declining phase and getting ready to turn up. Didn't get down to even the 50% extension, so it's not actually all that weak, and we think it's going to turn up. I'm really liking Exxon for a trade, and you can see the cyclical patterns right in here. It's a little late. You had this earnings report push it down on this downward gap, and I actually think it's going to turn up in here, and that Exxon is in pretty good shape. Next one we're going to look at in here is AT&T, that is telephone. In a video yesterday for my members, I looked at all three of the telephone stocks, AT&T, Verizon, and T-Mobile. That's the three that I follow. AT&T bottomed at exactly the right time. You can see that in here as the low came as expected, right at near this down declining period. Note here, we had a cycle breakdown right over there, and we told our subscribers that this was negative on the breakdown, and then you could see it declines through this whole period right over here. So see, it did the same thing right over here, declined through that whole period. Now look at this week right here. So it had a monstrous big up week there. It's the first week up of this rising phase, and it stopped here exactly in the intermediate resistance zone below the 34-week moving average. So we expect it to fool around in here, but overall that looks like a pretty good bottom. And if you get a pretty good pullback in there, earnings beat, and the investors loved it, so we think that that is the beginning of something in there. Take a look here at our short-term patterns in here, and there you can see our short-term cycles. This bottoms absolutely perfectly in there, and now our momentum indicator, the slim ribbon, which was negative right through this whole period. You see how red those bars are? And you see these bars over here are all colored red. That's because of the slim ribbon. It turns positive right over there. So all that negative momentum we had in AT&T is now gone. So if you're thinking about rotations and in pullbacks, AT&T is a stock that you should buy. Earnings better. Talk about earnings being better. How about Caterpillar? Man, this is incredible. It moves into this green rising zone after this sideways 1 month of going nowhere. You could see the correction in here. Look at each of these corrective periods. Those are those yellow periods you see right in there. This one was so unbelievably small. It says to me that, well, the analysts got it right and investors knew that this was going to happen. I got this one completely wrong in the beginning of the year because it was on my list of the riskiest for 2017. And man, they are really executing, and they're talking about the China demand really helping. And you can see in here, well, the target right now is 1. 17, which is that Fibonacci extension target zone, up to about 121. So get a pullback in here, and I think that Caterpillar is a great buy. Facebook is the last one we're going to look at, up 4% on the week. That gets up to that 78.6% fib extension. We are now entering, I think, a period of risk. Yeah, it really did good. Earnings great. Analysts love it, upgrading like crazy. But I want you to see the periods of risk in here. In other words, the declining or corrective phases, which are on the right side of each of these cycles. Well, that's where we are right now. What happened in all of them? Well, you had a 2-month correction here, a 1-month correction here, 6-week correction in here. Almost no correction as it just moves sideways right in there. You don't usually get 2 of those in a row, so we think it's going to falter in this area right around that 78.6% fib extension. That's at about 176. So it has maybe a little bit more room and then rolling over. You can, if you're a short-term trader, you cannot buy Facebook here. Facebook looks to me like it is going to be dipping pretty soon. So you like our charts. If you'd like to get the best 80 charts with my analysis on them, that's the really widely held, the best option stocks, and 24 futures charts and indexes with all my analysis on it, all this notation. You can get that for your TOS platform, Thinkorswim, and that comes to you once a week. We make adjustments, send interim updates when we think it's the right time to do it. You could have that right on your TOS platform. So just send me an email, slim@askSlim.com, and I will send you a special link for level 4, and you'll get that for half price for 1 month. And you'll also have our rankings and setups level 3, and you'll also have all 9 categories of videos for traders, investors, over 250 videos. So $64.50 for all of that. Come on, write me right now, slim@askSlim.com. And what we're going to bring you right now is the worst stocks for the week. All right, so the worst stocks for the week, we're going to take a look here at a bunch of airline stocks. Man, these things got hammered. What's coming out is that their passenger mile revenues have been soft, and the guidance numbers are not exactly all that good. And Spirit Air, SAVE, got absolutely wrecked. The 20% down for the week. They've got pilot issues going on. So this whole group, and I think it's really about the overspent consumer that is also affecting the airlines. And there's more and more talk about the potential that this 2.6% growth may be the best that we see. So we're seeing these airline stocks get really weak. It's wrecking the transportation average, as we said. And you can see in here the cycle analysis also on SAVE. So you can see that it's following that rhythm in there, and that it's in the last phase. In other words, it looks like it's got like 2 to 4 weeks of decline right in there before it gets into that rally, but it's gotten totally wrecked. You can see that. So these stocks, they don't usually recover from something like that without doing a lot of work. I would, unless I was very aggressive, this is not a stock that I would buy. JetBlue may be one that is a better choice. Take a look at JBLU. This one down 7% on the week, and you can see in there that based on the cyclical projection, it is getting into a place where it should rally. Also note the 34-week moving average, how it's given its support right in here and right in here. So it looks to me like it could be in pretty good shape. I mean, the stock earnings report, you can see right over here, if I can get that to highlight for you, they came out with a better earnings report, and the stock actually went down. That's been going on quite a bit in some of these because the guidance has been so bad. So they beat by about 9 cents, and the stock gets cracked. But this is an important area, and if I wanted to buy one, JetBlue to me looks a lot better than save. Take a look at Love, and you'll see this one down 7% on the week. And when you look at this, this looks like one that you really would not aggressively buy, right? Because, well, I'll show you. Here you could see the big patterns. These are called harmonic families when you look at that in the cycle. So when you look at where this decline is right over here, that says that, well, you might get a bounce in here, but it's not likely to hold and then move down again. So this one at the 34-week moving average also, I think you get a bounce, but then I think it moves down. I'm not crazy about buying this one. So, you know, I like JetBlue better. American Airlines, their earnings missed, and you can see in here, this one looks like it's got 2-3 weeks. This is a very good pattern, and Qatar has been looking at this stock. So what do I like about it? You can see it rallies and then it sells off, and it has a bullish configuration in it. So we have a projection that it's going to go up higher in there. And here's the 38, here's the 50% fibs. The levels there are 46.70 to about 48.40. That's the buy zone to me for this stock. You can see the 34-week moving average coming through there also. So right in that zone is the area that I think is a good place to be grabbing some of that one. So American Airlines, you can see down 5% on the week on an earnings miss, but this is a good looking cyclical pattern in there. Here is United Airlines. This one a lot worse. Why is it worse? Well, while American Airlines did this and is projected to do this, United Airlines, well, it gave up almost 100% of the gain. So it's done all of this. It's down near this cycle support. Here's those lows that we're expecting in the majors. And so 2-3 weeks, you get a rally and then down again. That's the way United looks to us. So I'm not anxious to buy that one at all. So you get a look at the airlines, kind of a similar and somewhat mixed picture in there. And I'd say JetBlue, American Airlines, those are probably the two that I'd be willing to buy pretty soon. Tech stocks, some of them got absolutely wasted. Unbelievable. Two of the stocks that have tended to be some darlings in the hard drive area have been Seagate and Western Digital. They had some massive moves and now massive breakdowns. This is another one of those stocks that had the very obvious cyclical breakdown to us and then absolutely collapsed. So you can see in here that here's your rising pattern right in here. You could see those cycles. And then this one gets you nothing and then breaks down and then to decline all the way through late August, early September. That's about where we think the stock market will do. And that looks like the low support coming in here just above the 30 number. So that is a pretty bad looking earnings, big miss. Analysts all over this one with lowering their rankings on it. And take a look here at the daily chart. So this is amazing. Actually, you see this big, huge kicker there on the revenue miss on the last earnings, and that was actually a abandoned baby, that one little bar that you see up there, and then it does it again. And you know that the slim ribbon gave you a negative signal right over there, stayed negative the entire time through this right in here, never even went neutral, and it continues to move on the downside there. So that's a look at Seagate. A bad pattern all along and still looking like it's not ready to bottom. Western Digital, which trades with it a lot, you can see right in there, earnings in line, but their forecast really disappointed. Look at this pattern in here. I mean, this is ugliness. Well, let's talk about why it's ugly first. The cyclical pattern. Now, you can see this upward stair-step pattern. So here's your idealized cycle. That's these lines right in over here. And you could see that the low and pointing to the low period, the low and pointing to the low period. So these are the declining phases pointing to the lows. Declining phase, point to the low, right? And now already failing right in here and pointing to the low. There's your intermediate support zone right there, but I think it's going to break it. This has a long time to fall in here. And you could see in here this dark cloud cover right in here. And this is an evening star pattern, and this looks like it's going to get wailed on. So earnings in this one, like I said, in line, but they are Absolutely. Their forecast was a big disappointment in there. So I would say this stock to me looks like it is one that's going to get hit a lot more. Twitter's a stock that we have liked. And then it got up into this resistance zone. We did a good job trading this one. And look at the cyclical patterns in here. So I'm going to help you. So you can see the important low here, right? An important low here, important low here, and important low here, and important low here, right? Like 2-3 weeks from now, you're getting this decline right over here, and they really disappointed there with their earnings report. The users were very, very weak, and the stock got a big move to the downside. I think that this stock is a long side trade. Somewhere in here when it bottoms in the next few weeks, I'm not exactly sure if it'll be this support zone or lower. I think it's going to get into another one of these periods in here. They are trying to change their model in ways that are going to be attractive. And see this low over here, this is at 14, about 14.10. As long as it's above that in the next few weeks, we're going to be in a bullish base that's built. And that's going to call for testing this $21 level again. So it would look like this, and you could see that cycle pattern in there. This was one that was similar. You see the base built right in here, and then it went up and took out that high. Well, that's what we're looking for right over here, the same type of a pattern. And Twitter, to me, looks like a stock that is buyable. Look at this daily chart right in here, and you could see it gets absolutely cremated on this earnings report, but we're getting into a period where we should get a bounce. I don't think that there's going to be a big decline at all in there. So that is a look at Twitter. Also in the technology sector, Micron down about 8% as a large holder sold off a bunch of the stock in there. That has an ugly toppy pattern in MU. And Corning Glass down 8%. Their earnings beat, and I like that pattern. I think Corning Glass is a buy pretty soon. So Micron, I think, big top forming. Corning Glass, I actually want to buy it when it gets a little bit more of a pullback. A few more stocks to talk about on the worst for the week. One of the stocks that I said I thought was going to be one of the riskiest for the year was Dominos. Well, it was a combination of valuations relative to the group, and just that saturation to me was a big issue for them. And so Dominos was one of the stocks that I thought was going to be certainly risky. It really made the call look bad early on as the stock jumped from about 160 to 221 in the first half of the year, but now things have changed. I made a point to say that, you know, when you look at the PEs in here in Dominos and you compared them to the rest of the group, that it looked really super expensive to me. Now you can see magnificent patterns. So here's your cycles right in here. You can see that's the ideal cycle. And if you take the ideal cycle and add in a directional component, instead of being this that you see right over here, it then turns into this that you see as you add the directional component into it. And it continued to do that all the way up there. And now look at it give up the whole thing right over here. Major top, major top, major top. That's what it looks like to me. And you could get bounces in there, but I think it's got trouble. So the next low is due end of August, just like a lot of things that we look at. And there's the major support zone. We think the stock gets to 160, 170. That's that support zone. And then gets a bounce and then moves down again. Earnings beat on all metrics. How's that? But it's saturation, and their growth in Europe weakened. So if they can't grow in Europe and they're on every corner here in the United States, well, that's why you get that big move to the downside. Look right in here. As you see on the daily chart, it gets what had support on that 89-day really nicely, and then it breaks down below it. And now if you get a rebound, you probably get a rebound somewhere up near that, but I think it's going to continue to fail. Huge selling. Look at the volume coming in here. So it might rest on the downside for a little bit, but overall we don't like it. Didn't like it. I still don't like it. Goodyear Tire is the next one we're going to look at. Look at this stinking breakdown. You could see that right in there. Cyclical patterns point to a decline into the beginning of October, and this one, earnings was in line, but their outlook was really disappointing, and you got a pretty good downside move started in there. Now, this is really significant based on the cycle. So the low due right around this area here. It makes the low and then breaks the low. When it does that, the odds of it continuing down are like 80%. So this bouncing here in Goodyear Tire, well, I think it's fake, and I think it's going to move down some more. Two more stocks to look at really quickly. Starbucks, SBUX, talk about a disaster. There's a major top in there. Note the cyclical rhythms. We'll just look at these last few right in here so you could get a sense for what we see, and you can follow them right in here. I mean, just incredible. There's your heartbeat of the market. Notice the bullish configuration suggests it would make a new high, and look at that. I mean, our subscribers had that, and now the engulfing pattern makes the top, and it absolutely collapses. Look at this. There's the timing for the low, right? So that says to me that Starbucks is getting sold out right now, and that it's likely what's going to happen is that it's going to get a bounce. Take a look here at the daily cyclical patterns. So when you look at this timing right over here, this is suggestive of the fact that it doesn't get a bounce until somewhere around the mid-August area. So that's that period right there says to me trouble. Now look right in here at these patterns, and you can see in here that when it made the low right here and then started to rally, we had these resistances in there, and there's that 89-day moving average. Look what it did. It tagged the resistance and then absolutely collapsed. So that was a beautiful thing right there. And overall, we'd say Starbucks still has a little bit of time to go on the downside, maybe 2 weeks. Then it gets a bounce, and we think that after that, no good. Amazon, the last one we're going to look at in here. And let's just go back right over here. Let's go with those drawings up as Amazon. There you go. Look at that. Green, yellow, green, yellow, green, yellow, all up. That's a look at an amazingly strong stock. We're in a corrective period right now. Look how brief these corrective periods have been. Almost nothing on the downside. We're looking for Amazon to get down here under 1,000. This would be about 985 down to about 955. That'll be our target into this August period right over here for this correction, and then you can see up again. There's your 161.8 fib extension, a perfect tag of that right there. What does that mean? Well, it means that this advance right over here, if you took 161.8 times this distance, it brings you right to here. And of course, that's a Fibonacci number, and it makes that huge extension number up there. And now see this long-legged doji? Long-legged dojis are pretty significant, and it's tired. It's gone too far. What happened to Amazon? Well, Amazon down some 1% on the week, but they are, of course, annihilating retail, and there's a cost to that, and their expenses are going way up, and that really brought a disappointment on the earnings side. So the stock moves down, but not much. 21 points on the day, 2% to the downside. Not a very big decline in there, but we think there's more coming. We'll look for, getting pretty significantly sub 1,000. So that is a look at the worst stocks for the week. I hope there was something for you in the best of the worst, and we're going to be right back with our short-term view. All right, short-term view for the coming week. Remember that we're in our two-year anniversary period here, and I've got special links for half price for level 2, 3, and 4. If you want to have our charts, or you want to have all our rankings and setups, or just the videos, write me slim at askSlim.com. Tell me what level you want to be. Go to the askSlim website, and you can look at all our levels, and then I'll be glad to send you that link. What we're going to look at here is the S&P 500 for the short-term period. So when we say that, we're looking at the S&P 500 on the daily chart. Now, when we do this for members, we look at 5 different groups of indexes and the bond market, the gold market, the oil market, so metals market. So we look at lots of things in a short-term view, but this is only looking at stocks. But I am going to share something with you that is a proprietary indicator that I think will be interesting to you. So let's take a look first at this S&P 500. Now, what I said last week was that I thought that there'd be a little dip early. They'd try to rally again, and then late in the week or the beginning of next, they would start to move down again. So it actually followed that pretty closely. The dip wasn't as deep as I expected in here. So this is the notes that I had on my paper here, and it actually followed that pattern really closely. What am I looking at in here is the cyclical rhythms. The smaller ones right in here are about 9 or 10 days. These are about 18 to 20 days. And you could see that one was 18 there. This one is really short at 16. And where we are right now is this is about a 15th day. So what are we looking for this week? Well, we believe that we are in the double sell-off area. You could see it's drawn right in here. That is a period of extreme risk when the intermediate patterns are due to decline, and we have that also. So I call that a period of extreme risk. I expect this week to be down, right? But we still have doubters and rebounders and positive momentum, and it's pretty hard to get a big decline for where we are right now. So we think it's down for the week. You get some bounce the following week, so I'm following this right in here, and then a big acceleration to the downside. Remember, we said August, early September was the period for that. So we have a period of extreme risk, a little bouncing period there, and another period of extreme risk coming right there. That is kind of an extended short-term view when you look at that. So I'm going to move in a chart in here for you to see, which is the askSlim market condition indicator. This is a proprietary chart that looks at the internals of the market in multiple time frames, really, and it's a very unique type of a indicator, and we built it to essentially be reflective of looking at weeklies, dailies, and intraday patterns, and gives us a sense for the internals, what's the strength of the market internally. You could see in here when you look at that we have all 4 major indexes, and you can see that when it's above this middle area, the swing zone, it's positive, and this has been in this 90 area now here for the last couple of weeks. Same thing for the Russell over here, the same thing for the NASDAQ, and the same thing for the Dow. You can see that. These are, even though you're getting breaks here, you could see the Russell starting to really weaken. Here's that NASDAQ. You have to get through this swing zone over here to be negative. So I wanted to show you this indicator, our proprietary indicator. So you could see that while we're looking for the market to move to the downside, while we're looking for significant corrections in here, the market internals have not started to break down yet. It's because the longer term internals are so strong that as this starts to roll over, they're not affected yet. So this is a weighted type indicator. People that are our level 4 subscribers, 3-month subscribers, get this indicator for their TOS platform, and it works on everything, and it's just a phenomenal indicator for looking at market internals. So I wanted you to see that. So our projection for the week, again, is that it's likely to be a down week. We're looking for it to decline into this support zone right over here, getting down to somewhere between 2460, 2453. If there's risk in here, the risk is to the downside. In other words, it could be worse than we have a drawn in here because we're getting to this area of extreme risk. So we're looking for a down week in the market this coming week, and as we say, the risks are building, or you could say the risks are to the downside. That is our show for today. I hope there's been great information for you. Don't forget slim at askSlim.com if you have any questions or you want our special half-price links to try any of our levels for 1 month. We're not going to be doing this forever, so it's kind of an anniversary special that we're running them all at the same time. So any level of trader that you are, we have something for you. And send me that email and I will send you the link. Don't forget, follow me on Twitter at askSlim, and follow us on YouTube too, because we want to let you know and be alerted when our show comes out. So make sure you follow us on YouTube. That's it for the show for the week. Be careful because it is crazy out there. And I'm always wishing you great trading.
Well, I'm going to the city and I'm gonna do a city show.